Welcome to PlanStrongerTV. I'm your host, David Holland. At each stage of life, Americans face a different set of financial risks. Early in our careers, the risk of job loss and disability. Later, it may be long-term care, inflation, and longevity. On today's program, I'm joined by Dan Slater, an actuary who will help us understand why it's prudent to transfer certain risks to insurance companies. Let's roll. And welcome back. So we're going to continue our conversation today about shifting risk to insurance companies. And I'm very pleased to welcome back to the program Mr. Dan Slater, flying in to visit with us here in the studio. So Dan, welcome back to the program.
Thank you, David. Glad to be here again.
All right, excellent. Yeah, I appreciate you coming back to us. And for those members of the audience that didn't get a chance to watch the other program we did together, I want to reintroduce you. You have a firm called Core Income Advisors.
Yes.
And
right.
you're based in
Minneapolis,
Minnesota.
yeah.
Minneapolis, Minnesota. All
Yep.
right. Very good. Downtown or your suburb?
A little out west of the suburb.
All right. Get out of the town.
Yeah,
All right.
yeah.
So, and the work you do is a lot with advisors and agents.
Yeah, so yeah, we kind of work with advisors on helping understand the insurance marketplace. That could mean annuities, it could be life insurance or long-term care. I always call them risk-based products.
Okay.
So really, where are you looking to pass a risk on? We really help advisors maneuver through that market. There's lots of companies and product selections.
And it changes sometimes, right?
Yeah, exactly. So, you know, we support advisors like yourself, national base, but definitely kind of a consultant, expert consultant on that
Excellent. Well,
stuff.
we appreciate what you do, and I know that our viewers today will really appreciate your perspective on transferring and shifting risk to an insurance company, and we've talked about this with annuities. I also want to talk to you about long-term care.
Yes.
You know, long-term care is not a subject anybody wants to talk about. I've never had anybody come into my office and say, David, I've just been so dying and anxious to talk with you about long-term care.
Yeah.
How can I sign up?
Yeah,
you know,
right.
So it's not a topic people really enjoy, but it is an important part of retirement, planning for retirement, and as people live longer and our health care, our wonderful medical services and the discoveries that are made every day, allowing us to live longer, also means that there's, of course, a greater chance that we'll need some forms of care down the road.
Right.
And so this is becoming more and more of an issue and concern and a factor or something we need to allocate resources to in retirement.
Yeah, and I think, you know, a lot of that comes down to education, right? You can't manage a risk if you don't understand the risk, right? And as you mentioned, living longer, the healthcare system, you also don't have some of your traditional forms of caregiving.
Ah, that's a good point.
You know, where generations prior, you know, it took a different form. And now families are more spread out, different
Dual
demands.
income.
Yes,
Yeah.
Dual incomes. You know, how do you handle the variety of situations, not just long-term care from call it the nursing home perspective, but also like the Alzheimer's, you know, dementia, things that can have a very early onset, have very different phases, and could last many years.
That's true. And you've made another point I wanted to get to, which is that with the care settings evolving, you've got a lot of things now that can be done in the home that would amaze medical professionals, you know, 20, 30, 50 years ago.
Yeah.
So, I mean, what you can do in the home now and where you can stay in your own home and get care is wonderful, but there is a cost.
Yes, and that is the big thing. I think current statistics say 80% of people's initial claims are home health care.
Sure, that would make sense.
So it's about staying in your home and maintaining your quality of life as long as, you know, your spouse is there and things like that. So it's how does it fit for you, not how do you fit into that world.
Yeah, and it may start 80% of the times in the home, but there's another statistic that I recently saw that 60-some% of women will experience extensive care, not just a stopover for a little while in assisted living or a
Right.
month or two, but we're talking about an extensive period or extensive care. And I know what that means. When I hear the word extensive,
Yes.
I know that's expensive.
Right, and to a retirement plan, that's catastrophic.
Right, okay.
Right, and I think that's what, you know, especially you start to look down the Alzheimer's routes, that's an average of 8 to 10 years.
Wow.
You know, and you can take, you know, varying range of expenses, different markets have different costs, but that can wreak havoc on your retirement plan.
So there are different schools of thought and a lot of different ways of approaching this whole area of long-term care and how to deal with it.
Yeah.
I think I'm on the same page as you are, Dan, about this, and I like the idea of identifying what the risk is, evaluating what the potential cost or impact may be on the retirement or the portfolio, and then think about what are we going to do about it. If somebody really wants to just accept the risk, okay.
Yeah.
But let's at least have a conversation about whether we want to transfer some of that risk. And when we talk about transferring to that insurance company, we're talking about buying an insurance policy,
Right.
correct?
Right, well, and I think that's important because you often think of yourself as the self-funder, but I think
Right.
you want to make that as a conscious decision, not a subconscious, I didn't
Right.
quite
Or
assess
just
it.
something we dismiss and say,
Yeah.
we'll plan for our financial future tomorrow.
Right, well, and this starts to become a very interesting topic of long-term care in managing the risk because it's not just a financial risk.
Yeah.
There's always such an emotional component that goes
Absolutely.
with it. And, you know, having your playbook or your plans in place before the event happens is really where we see, I call it success, but people being able to manage things and having that peace of mind that they'll be taken care of. So yeah, what do you have for options? One is to do nothing, but
Right.
hopefully you would make that decision. The traditional long-term care market has generally been fading away. And what you're starting to see, and the government allowed this event to happen, they passed the Pension Protection Act, which allowed insurance companies to create some new innovative products. So it has to do with an asset-backed long-term care policy. And that kind of changes a lot of the dynamics. I know we don't want to dive real deep into that, but there's some different alternatives that change, you know, the risks, but also if that risk doesn't develop, because that's always been a concern is, you know, much like your homeowner's policy, you're paying in money and, you know, and nothing happens and, you know, you pass away and all that money's gone.
Yeah, and you're like, golly, I spent all that money. And I am familiar, and we've used your firm to help us look at some of those policies, Dan, and I think that's an important thing for people to think about is to look at how to best deploy their assets to address a risk. And if you can have your cake and eat it too a little bit with some of these policies where you can have a policy, but if you don't need it, there's money that comes back to the family or whatever the case may be. It's definitely worth considering. And there is a shifting landscape. You know, it used to be you paid a premium every year and you had a policy, and if you never need it, it's like, again, auto insurance. But it's worth the time and the energy just to, you know, take a few minutes and look at it.
Right, yeah, I mean, you know, when it comes down to insurance, the value of insurance is the ability to get leverage on your money.
Sure.
And so when you look at a long-term care policy, if you're willing to spend so much, can you get 6 or 7 times leverage on your money for long-term care? And as we know, that's a tax-free benefit. Again, the IRS has made that a tax-free distribution. So there's benefits even beyond just the leverage. But if that event doesn't happen, you know, that, you know, not everybody uses long-term care. What are the other provisions there that, not necessarily call them outs, but call them a secondary provision, you know?
Now, in the work you do, you're working with a lot of agents and advisors all over the country.
Yep.
So in doing that, give us a sense, or maybe give the consumer a little peek into this process. Do all advisors and agents really, you know, look at a bunch of different choices? You know, generally, do they know what they're doing?
Right.
I mean, do they take the kind of advocacy that the consumer is expecting? What do you see?
Yeah. Good question. And that's a very wide answer. It's a very wide spectrum. You know, a lot of people look at retirement and managing money and so on, but they don't always look at what risk could impact that money.
And blow the whole
road.
plan up.
Right. And as you know, healthcare risk is probably one of the biggest that's unaddressed.
Right.
So, you know, again, we work with annuities and life insurance and all that, but what we've seen over the last couple of years is long-term care is highly unaddressed.
You mentioned a statistic that I'm sure you can give to the audience that you were doing a talk, and I was listening carefully to you, Dan. You're talking about the concerns that people have going into retirement, and then they did a study, I think this is from the American Society of Actuaries,
Yep, correct.
that then looked later. Share with the audience a little bit about that, because I think that would be helpful for
Yeah.
some perspective of why this is such an important issue.
Right, yeah, I mean, we've talked about the fact that most people, we believe when we did annuities, we talked about longevity and not outliving your money. You kind of think that's retirees' number one concern. Well,
Right.
the Society of Actuaries did a study, and in reality, what they found for people 65 and older is the number one concern for retirement is healthcare. And it's predominantly probably because they haven't addressed it yet.
Right.
For 30, 40 years of retirement, they focused on accumulating that money, getting it bigger, rates of return, and now, the annuity market's somewhat developed, so the idea of making sure I have a pension-like asset.
Sure.
But long-term care is not something most advisors have addressed with clients. And so, obviously kudos to you and your firm to be able to pull that in, and
Thank you.
all risks, again, it's client's number one risk, yet it's amazing that most advisors don't address it.
Well, I think the other point you made, which is really kind of key with people looking at healthcare and saying, hey, this is something that's a big deal, it's not just that they've been focused on the accumulation, now they're thinking more about retirement, but it's also they look around and they have friends and family who are experiencing healthcare issues, or, when I talk to clients, so many of them will say to me, I'm glad you brought this up, David, because we have our friend or neighbor or brother or sister or whomever that had this situation. They hadn't addressed the long-term care or healthcare issue properly, and it really was a problem. And they say to me, we don't want to be in that situation.
Yeah, and like as I mentioned earlier, it's a very interesting topic in the way that it can have such a financial catastrophic impact, but the emotional component at that same time. And that's really what you start to see when it comes to the impact it has on your spouse,
Sure.
who generally becomes your primary caregiver. And that can work when you're 50s, but when you're 70, 75, and that stresses on your spouse, or, you have 3 kids, different parts of the country now,
Right,
not everybody just stays home by mom and dad. What does each kid do? Some financial, some don't have the financial means, so they do the caregiving, and that's where you see a lot of the stress. So, as you go around, and I've done it, worked with a lot of advisors around the country, it's not anywhere different, is everybody has their own unique experience when it comes to like long-term care or Alzheimer's, and, it's their family or their friends, and as you can tell, there's an emotional toll to it, but
Sure.
when we break down the numbers, the average Alzheimer's event runs you about $800,000.
Wow.
And
how do you pay for that?
yeah, and so what can you do in advance, like you said, is what do you have in your playbook?
Right.
If you don't have anything in your playbook, that's
You
tough
can't make it up as you go. Or
Yeah,
you can try. And
Yep.
Well, you spoke to something I think is very important. You talked about the financial costs. You talked about, evaluating how we're going to deploy our assets to address that. The thing that's often overlooked, and I know you're very aware of this, Dan, but what's often overlooked is when you don't have the proper plan in place and you're scrambling.
Yeah.
Then you have a family member who's going to be the caregiver. A lot of times the kids will say out of obligation or whatever that I'm going to take care of mom or dad.
Right.
Well, what we don't talk about is the financial impact of that decision.
Right.
And a lot of times it's the daughter.
Yep.
If a daughter isn't able to work, has to retire, go part-time or whatever, leave the workforce,
Yeah.
what are the long-term financial implications of that scenario?
Right, yeah, and just what that has as rippling effects. And, those scenarios, I hear those stories quite often, but,
Sure.
when you have that parent come back in and live with you, it's usually great for the first 4 weeks. You got a companion at home and someone's at dinner, and then after that, for a year or 2 years, that starts to become, a physical toll, emotional toll, and like you said, even a financial toll on the caregiver.
Right.
And, part of that is you could have done something in advance to make, life easier for everybody. They may still want to take care. They still may be a primary caregiver, but they're not the only caregiver. And I think that's a big thing.
I think that's a big thing. And I think also want to make sure that the audience knows, Dan, that we're not, just talking about people that have resources. I understand that there are people that don't have resources. They're like, well, what do I do? I can't drop, X amount of money on a long-term care policy.
Right.
I'm not insensitive to that.
Right.
You have to look at what's best for your situation. But if somebody has financial resources and given the possibility or probability of needing long-term care, and if you can get a policy, I think it's definitely worth the conversation, at least to evaluate.
Yeah, I say absolutely. This is becoming a big epidemic to our country. People used to have those more steady income assets like pensions, and majority of their spendable needs was from Social Security. But now, most families have a large qualified pot of money that if you have to start liquidating something, that's probably the primary source, and that creates its own tax issues and all these things. And and if you can dual purpose some of this money, like we said, long-term care, maybe some life insurance with it, it gives you more options. And from the government standpoint, that's why they're passing these laws, because, like you said, for the people that don't have enough assets or resources to do it, there are the things like Medicare and Medicaid, but, that starts to become more of a social issue.
Correct.
And how we make sure that's funded. And, that's the big thing today is people have those 401ks that you have to protect. And if you wanted to live on the government, you know how that works. You got to spend down all of your money first.
That's right. We are a compassionate country. We take care, and of course there's always going to be an argument that we don't do enough, and I understand that. But we do have Medicaid for people that don't have anything. We have Medicare that provides some long-term care benefits. They're limited, but I think it behooves somebody that has resources to sit down and say, all right, let me look at my options, and if ultimately the decision is I'm just going to take my chances, so be it.
Yeah.
But at least have that conversation.
Yeah, I think it's all about quality of retirement. If you have a plan in place and you have a policy that pays for a qualified caregiver to come take care of you and help support your spouse who they take care of you, but they're not qualified to the same medical needs, and you have somebody that can pay that bill, you're going to enjoy your retirement, much longer throughout your years.
Yeah, well, very good. Very good stuff, Dan.
Yeah,
glad you could come back and join us and be with us. Dan Slater, ladies and gentlemen, we're glad to have him with us, and we'll be definitely asking Dan to come back and join us again and talk about some other related subjects. Thank you very much, Dan.
Appreciate it. Thank you,
All
David.
right, you're very welcome. Okay, it's time for viewer question. That's the part of the show where I answer your questions. Today's question comes from Robin Long in Palm Coast, Florida. Robin writes, I recently read your column in the local paper about continuing care retirement communities. I would like to know your personal position on CCRCs. Do you think they are a good idea? From my own reading and research, it seems like there are other forms of long-term care that might provide similar services and coverage. Are you aware of what they are and the definition of each? What do you recommend? First, let me say a quick thank you to you, Robin, not just for the excellent question, but also for the compliment of following my weekly column in the paper. I'll keep writing if you keep reading. I'd also like to take a second here to remind our viewers that if you ask me a question and it's appropriate for our television audience, I'm going to give you a straight answer. Nothing sugar-coated here. I'm going to break the question down into 3 parts. Here we go. First up, Robin would like to know my personal position on continuing care retirement communities, CCRCs. Do I think they are a good idea? The short answer is yes. The long answer is it depends on your individual situation and preferences. The advantages of a CCRC include a defined upfront cost and a specified ongoing monthly fee. Care can be all-inclusive. In other words, you pay what you agree to in the contract, and they take care of you the rest of your life. Depending on the facility and services available, you move within the community as your level of care is required for your stay. You can start out in an independent home, then move into assisted living, then into a nursing home or memory care unit. These different levels of care are built in. You don't really need to plan for them when the actual need arises. You just have to fork over the upfront buy-in fee to join the community and make arrangements for the ongoing monthly fees. One of the most often overlooked advantages of a continuing care retirement community is the community aspect. Many of these organizations place a heavy emphasis on wellness and community activities. Now to the disadvantages. You have to shop around. Do your homework. Communities and the contracts you sign to get into them can vary significantly. If you find one you like, I recommend having your attorney or advisor help you review it and make sure you understand it. You need to know what the costs are. Are they fixed? Can they change? What services are included? Which ones aren't? The potential disadvantage is that you could also be somewhat locked in to a community. Think about it. You probably have sold your home and plunked down a rather large sign-up fee, which may be in the hundreds of thousands of dollars. And if you want out, you need to know beforehand how much of that money you get back, and how you'll make the transition back into a home or other living arrangement outside the community. Now, to be fair, the other long-term care choices won't be cheap either. We'll get to those in just a minute. But before we do, let me summarize. CCRC advantages can be all-inclusive with known cost. CCRC disadvantages, not uniform, requires homework, somewhat inflexible, and usually requires a large outlay for something you may never need. Now for the second part of Robin's question. From her research, Robin found that there are other forms of long-term care that might provide similar services and coverage to CCRCs. She wants to know if I'm aware of what they are and the definition of each. The answer is yes to both of your questions, Robin. Yes, there are other forms of long-term care besides CCRCs, and yes, I can give you an overview about them right now. Let's first talk about the types of care and then how we'll pay for it. Generally, long-term care takes on different forms that increase in intensity depending on your personal needs. There's home health care, where you get care in your own home. Then there's assisted living care that is provided in a facility. The level of care and living space and arrangements will vary by the facility. Then there are skilled nursing facilities, where you receive nursing and medical care. With the growing incidence of Alzheimer's and other form of cognitive decline, there are also what are called memory care units that are designed specifically for these types of patients. Now, for how you'll pay for it. Different care obviously costs different amounts. Depending on where you live and what form of care you need, home health care may only be $2,000 a month. The monthly tab for a no-frills assisted living facility might be $3,000 or $4,000 a month. And a private room in a skilled nursing facility could run $8,000 or more per month. It's important to note that these costs have been increasing at a faster pace than the overall inflation rate. And with 10,000 baby boomers turning 70 every day, I doubt that the demand for these services will fall or that the cost will go down. So if you or someone you are financially responsible for needs care, where do you get the money? There actually aren't that many options. Number one, self-pay. Some people intentionally plan on just paying for whatever the care may be that they need in the future and forego other options. You write a check from savings or your monthly income. Also keep in mind that you probably won't be spending as much money on other things like travel if you require the more expensive care. Number two, buy a long-term care insurance policy. I could do a whole show just on the different types of policies and the advantages and disadvantages of each kind. For example, some policies, you pay a premium every year. For others, you make a one-and-done premium payment. Number three, qualify for Medicaid. And when you legitimately run out of assets, long-term care benefits are available from Medicaid. Medicare, however, is an insurance program for those 65 and older and others who meet certain qualifying conditions. Medicare offers limited long-term care, and generally the care must be recuperative in nature, not custodial, and must follow a hospital stay. And lastly, Robin wants to know what I recommend. Well, Robin, that's the hardest part of your question. I'll try to give an answer besides it depends. I'll begin by saying that I have a bias. I'm a big fan of flexibility and control. I often recommend keeping a healthy emergency fund and buying a long-term care insurance policy that will cover the primary types of care that may be needed. The most important thing I've learned over the past 2 decades is that the financial plans really need to be carved in jello, not in stone. With a long-term care insurance policy, I think we'd have more control over where and from whom we receive care. Of course, we still need to dig in deeper and decide on the particular type of policy we want to get. I do favor the one-and-done premium policy I mentioned before. I also recommend policies that have a cash-out option and a death benefit for the family if the policy really is never needed for long-term care. Probably the most important thing I can say about long-term care and long-term care insurance is that it should be evaluated as part of an overall financial and retirement plan. I don't think it should be evaluated by itself in isolation. There have been many times when I've recommended long-term care insurance, but there's also been plenty of situations where I told a client that they shouldn't get it, can't afford it, or don't need it. Thanks again, Robin. Great question. And thank you all, ladies and gentlemen, for watching the program.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.